Hi, I'm Batu from freefincal, and today I have released this free ebook. This has got 100 essential questions and answers for new mutual fund investors. So, first of all, these are 100 questions that new mutual fund investors should be asking, and then they should look for answers. Of course, these are answers in my opinion, and your opinion may be different. So, this post is linked here, also in the description box. You can also download this entire collection as a PDF book right at the bottom of this article. Please do share this with other mutual fund investors in your circle. It will help everybody. Others who want to invest in mutual funds, it will help. I hope it will help others. This is not some nice and easy, rosy, I should say, not easy. It is easy enough, but nice and rosy picture of mutual funds where you should invest for long term, you will get returns, and that kind of propaganda. This will present the truth about mutual funds that everybody should understand before they start investing or before their net worth grows big. So please do have a look at this, and of course, as I mentioned before, this has been released um, uh, on the 7th anniversary of freefincal, which is just a few days ago, I think. And I thank everybody who has contributed to the creation of this ebook, and also all the readers and viewers who have supported me in the growth of not only the website but also the YouTube channel. So with that, I'll just quickly head over to this week's Q&A. So let's get on with it. Let's not spend too much time. Let's see, 15 minutes or so, or 20 minutes. What is the difference between HDFC retirement savings fund, HDFC hybrid equity plan, and HDFC hybrid fund direct plan? See, if you want to know the difference, please Google. Uh, I'm also going to do the same. I don't know the differences offhand. If you want insight, I can, after you find the basic differences, you list the differences and you want to know when to use what, I can offer you an insight on this. I mean, based on my opinion and my understanding. But I cannot be giving you basic differences which you can easily find in Google. What if Nifty crashes like the Japanese index Nikkei and never recovers? See, this is a problem that many investors have. First of all, you should, I probably think I should do a full video on this. Please understand that, go look at the Japanese GDP and find out what was their GDP when in 1989 when the index crashed. What is the GDP of India today? You will understand that by 1989, the Japanese economy was fully developed. It was almost at saturation, and then it crashed. Even though it crashed, it's not like people are suffering. What Nifty? So what if the Japanese index negative returns? Then inflation is zero. So if the inflation is zero, why do you want equity investments, right? So please don't look at just the index and start comparing it with Nifty. You have to look at the country's economy. You have to look at the GDP, the growth of the GDP. Is today's Indian GDP comparable to that of Japan's GDP today? Go find out. When you know this, automatically you will understand that you can never have a Nikkei-like situation in India for a very long time. If you have a Nikkei-like situation in India, this means that India is a developed country. We all should be very happy about it. We do not need equity anymore. Screw those mutual funds. So don't just compare indices and assume that Japan will happen in India. I had this is a video on the getting a stock price and 52-week price in Excel directly. Where does Excel source this from? They seem to be getting it. I don't know the source of the feeds, but they get both NSE and BSE, and it's live. So I think it could be directly from the index itself or some other third party. I do not know the exact source, but it's a very nice utility for those who want to do it. Just have a look at that video. Thank you for the DSP Quant Fund. Okay, thank you, Vinay. This week's Q&A says Rajiv. Yes, this is it. Jyoti Mani has an opinion about building a stock portfolio. You can have a look at that. That's not a question. It's his strategy. He discusses that again here. You can look at that. This is a question on some other videos too long ago. Don't worry too much about that. Active fund review this week. No active fund review this week because of this ebook which was released today. That's why. Otherwise, I would have done it. I also need a break and bored about looking at funds. Aman says you're the finest source of free advice. Thank you. Thank you, Sanjay. Thank you for a beautiful video. This is a DSP Quant Fund. He wants to know if there is any this multi-factor strategic indices. There are only low volatility ETFs. There are a couple of low volatility ETFs, but not this multi-factor indices. Shashank is one of the best channels of mutual fund investing. Thank you very much. It is not it takes two to tango. Unless the viewers are good and they push me in the right direction, all channels will die. So it's not just one person's effort. Nowhere is it one person's effort. Thank you. Tax implications for NRIs. Okay, this is what I want. Okay, now what I want you guys to do is to go to Google and search for Tata Mutual Fund Tax Reckoner, and you will get this PDF file. This is an awesome PDF file. You can use, anybody can use it, NRIs, resident Indians, domestic company. It will tell you the exact tax rate from received tax implication on dividends, long-term capital gain, short-term capital gain, the full data. Just one nice PDF file. This is official from Tata Mutual Fund. Of course, this will change from financial year to financial year, but this is the current information. Please check this out. You will get all your answers. Okay, so thank you, Narayanan sir. Which website are you using to show charts of investment? See, I just use Excel, and those Excel graphs I pasted on PowerPoint to show you this. Thank you for the 7th anniversary wishes. Yes, he wanted to know the DSP Quant Fund review that has now been published. Like and share. Thank you. Let's move forward. I saw some questions on portfolio something. New subscribers. Thank you. Yes, it's an opinion about the elections. Yes, I will be more regular on weight loss Wednesdays. I've been skipping the weight loss Wednesdays for 3 Wednesdays now. I've skipped it. We will be more regular from this week. A lot of backlog on this. We talk about sugar. So he's talking about how to find an alternative for jaggery. Please don't. He says there's something called stevia, which is a natural extract. I think root from some extract of vegetable, whatever. I forgot what it is. But please don't use any alternative to sugar, because anything that you extract from, when you separate the sugar from its natural source, then it becomes toxic. So don't use anything natural, artificial. Don't use any artificial sweeteners. Avoid sugar in all form. My tongue has become so sensitive that if I cannot handle some sambars. If you go to Karnataka, if you drink sambar or rasam, they will add a little bit of jaggery there. I cannot handle that. I've become so sensitive to that. My tongue has become sensitive that I am able to, because I have not touched direct sugar at all. I eat peanuts, I can sense the sugar in it. So it becomes very sensitive to that. So it will better to satisfy your taste buds using those natural forms of sugar, and we'll talk about that in some more detail. Right, that's not a question. 2 ETFs from the mid. That's an interesting question. 2 ETFs from the mid cap space. ICICI mid cap select ETF, Reliance mid cap Nifty 150. I don't know about the Reliance ETF, but the ICICI mid cap select is a very interesting ETF, because so far, even though the AUM is low, they have managed to keep the price and the NAV difference quite small. That is because they have a very active intermediary who's been doing a good job of making sure that there is no NAV price difference. This is something that you should consider. Keep it on your watch list if you want to have a choice. But I don't know if you want a choice of index investing in the mid-cap space, but I don't know how the volumes will play when the money when your net worth grows in the fund. So it's better to have the AUM grow a little bit and watch what happens. What you should look at is when the market crashes, and eventually someday it will, look at the price NAV difference for the mid cap ETFs, low volatility ETFs, and so on. That is the time testing time. Quant funds, yes, I have reviewed them. SBI focused fund, I will. This is an interesting question. See, this is the kind of questions I like, although I may not be able to answer it offhand to RP satisfaction. Which asset allocation would give better risk-adjusted returns? 70% debt plus 30% mid-cap, 30% debt plus 70% Nifty 50. Backtesting shows that both gave a CAGR of 11% over a period of 10 years during normal circumstances, but A seems to do it with less volatility and comes with lesser risk of a total collapse in case of extreme sell-off. That is very, very true. A is definitely will have lower risk, but the problem is, will that A portfolio give you a return comparable to the B portfolio for every 10-year period in the past that you have tested? You have tested one 10-year period. That's the problem. It may not happen in future. That is, you have guaranteed lower risk, but it may not match the returns of B. I don't know. May or may not. I don't know. But it's a very good question. That's the question I love. What is the rolling return and rolling risk for Nifty blend? What is rolling risk and how is it calculated? Rolling return, rolling risk for Nifty blend. If you search for freefincal Nifty blend on Google, you will get it. Nifty blend means this is a mixture of Nifty 50 and Nifty Next 50. You can have different blend proportions. I have done all this. You please search for it, you will get it. What is rolling risk and how is it calculated? So that's a good question. So okay, let's see. How do I show it? Okay, so let's say I have a period here. So this is between my fingers, that's one duration, right? Let's say this is 3 years, one 3-year period. During these 3-year periods, I take the monthly returns, right? So that is the difference in, there is absolute percentage difference between start of the month and end of the month. So I take the monthly returns and I take these, how many are there in 3 years? 36 monthly returns. Yeah. So I take these 36 monthly returns and compute the average. Then I find out how much each of those 36 monthly returns deviate from this average. And that deviation, if I calculate the average of that deviation, I will get something known as a standard deviation. It's defined in a certain way. I don't want to get into the math. So that's the standard deviation. So I have computed the average deviation of individual monthly returns from the average monthly returns for this one 3-year period. So that's the standard deviation. Now I shift this 3-year window 1 month forward. So if I start from January 2016 to January 2019, that's one 3-year period, I shift it to February 2016 to February 2019. That's another 3-year period. Repeat the calculation again. Shift it by one more, shift it by one more, shift it by one more. And I keep doing this for every possible 3-year periods, 5-year periods, whatever duration periods in the past, and plot all the standard deviations that I get. That's the rolling risk. That's how I do the same thing for returns as well, but in the case of returns, I will compute the CAGR or the XIRR between for that for using the start NAV and end NAV for the 3-year period or 5-year period and calculate all and show all the returns. That's how I calculate rolling return and rolling risk. I have one doubt. Does Nifty 100 consist of Nifty 50 and Nifty Next 50 stocks, or are they different? It's a very good question. See, Nifty 100 has all the stocks of Nifty 50 and Nifty Next 50, but because Nifty 100 is a market cap weighted index, the stocks with the largest market cap, free float market cap, will have the highest weight. Therefore, there will not be much of a difference between Nifty 100 returns and Nifty 50 returns, but the Nifty 100 risk will be lower than Nifty 50 because of more stocks. Higher the number of stocks, more the diversification. Nifty next 50, because it has got a mixture of some large cap stocks and some mid cap stocks. The stocks in the bottom of the Nifty 100 are more or less mid capish. It will have much higher risk than both Nifty 100 and Nifty 50 and the potential for higher returns. Thank you for all the videos you make. I've learned many things about investing and personal finance. Thank you, Hari Prasad. I have a question. With an actively managed mutual fund, I can expect the fund manager to provide some downside protection, and that might encourage me to stay invested when the markets are going down. I won't have any downside protection when investing in index funds. Are there any strategy I can use to get downside protection while investing in index funds? Great question. So the only strategy you can use to ensure downside protection while investing in index funds is by using tactical asset allocation, market timing. I have done videos on this. You can check them out. I have an entire category of posts on this on tactical asset allocations. You can look at it in the sidebar and at freefincal when using your desktop or a laptop. Otherwise, the sidebar will be at the bottom in the mobile device. But what I would recommend is, if you are worried about it, then you go for hybrid funds. You go for aggressive hybrid funds, balanced advantage funds, multi-asset funds. There you are guaranteed of downside protection, and you will get reasonable performance. In an actively managed fund, you are not guaranteed of an actively managed diversified equity fund. You are not guaranteed of downside protection. Some funds will give you downside protection, some funds will not. But in a hybrid fund, you are guaranteed of that. You can choose that. I also have multiple videos on this. Please check them out. How to combine Nifty Next 50 and active funds. Many videos. You can have a look at that. It's a response. In one of your videos, I heard that Nifty Next 50 is volatile compared to Nifty 50. So I would like to know if the returns would be worth the risk taken. I have aggressive risk appetite. First of all, how do you define aggressive risk appetite? How many market crashes have you faced to know whether you have aggressive risk appetite or not? Second of all, will the risk taken in Nifty Next 50 pay off? I don't know. Sometimes it will, sometimes it may not. That's the truth of the matter. That is the reason why you have to have a combination of Nifty 50 and Nifty Next 50. Either you systematically rebalance the portfolio once a year, or you tactically rebalance. Unless you do this, you cannot reduce risk in the portfolio. There will always be a problem. When do we? This is a question Jyoti Mani again has. When we decide to go with index investing, why don't we stick to Nifty Next 50? Because of better returns than the blend. See, I have answered this question. That's just past data. I mean, in the future, you don't know. That is, never forget. So easy for investors to forget about past performance. Just because Nifty 50 has performed well in the past doesn't mean it will perform well in future. Please recognize, when past performance is applicable to past performance disclaimer is applicable to returns, but past performance, you should always look at the past risk and assume that will be the minimum guaranteed future risk. You will definitely get that much risk you will get. Notice how the Nifty Next 50 has crashed in 2008. It's extremely scary. So please don't assume it will beat anything. I think that's that. That's what we have had a 20-minute session. So I'll stop with this, and please download the MFFAQ ebook, share it with others. Let me know what you think about this, and I'll catch you in another video. Bye bye.